Good morning, everyone. Good to see a few familiar faces here in the audience. Actually, a lot of familiar faces here in the audience. So, look, what I want to do today is run through a short deck that we've got, which really just covers a few key thematics that I think many people will already be familiar with. But we'll sort of step through those, then I guess, give our views on where we see things, and then how, we as an investor, as a private equity investor in the resources space, are looking to take advantage or play those opportunities. So look, we'll open up here, and I think this is something that most people will be familiar with. But the energy transition, it started off, and I think there was some doubt about whether it would get momentum and sustained momentum, but there's no doubt that net zero changes everything. This is definitively a mega trend which has got unstoppable momentum. There will be ebbs and flows, and I think one of the really important things to sort of take away from this is that in some ways this is a forcing function where we've rarely, if ever, seen demand side on metals and mining in some ways decoupled from global economic growth, or an extra layer on top of global economic growth. So it's an unusual situation. It's quite a complex situation, and we'll step through the various pieces of that today in terms of the complexity and how we're looking to play it. So if you look here, as I said, the rule of big numbers. So it doesn't matter which of those numbers you look at, they're pretty enormous. It impacts right across the whole spectrum of the energy transition and carbon reduction and abatement. So it's really all of these things, when you put them all together, have a very significant impact on the metals and mining market. So here we had two scenarios. The first of those is the stated policy scenario. So this is the one on the left-hand side that those governments, the 197 governments that we've seen on the first slide, have already signed up to. And we see the impact of those policies through the next 3 decades, so through to 2030 and then through to 2050. And then on the right-hand side, what we call the high climate ambition, or the sustainable development scenario. That's a scenario where 1.5 degrees Celsius above pre-industrial age is maintained. And you can see those two scenarios there. That's in terms of the Paris Climate Accord. The one on the right is the one that they'd like to achieve, and that's the one essentially which requires a 50% reduction in global emissions on the right-hand side. So that's a pretty massive target. But the one on the left-hand side is actually the one that governments have signed up to today. So you can see, it's not all commodities on here, but you can see the impact on the range of commodities that we've included here on the slide. So, and these range from some of the very large bulks markets like aluminium, which is on the bottom. You can see the massive change in the aluminium market, already a very, very large market. Likewise, copper, which is a 22 million tonne market. If you look at just, let's just take the stated policies on the left-hand side. Essentially, the yellow is copper. That's a 45% increase in the size of the total copper market by 2050. And likewise for zinc, which is the next one in the blue, the two blues there actually, zinc and nickel. very substantial sort of increases as well. Now, there's a whole range of other commodities or metals and minerals, and you can see those listed here: silicon, lithium, manganese, chrome, cobalt. They are all much smaller markets. They're all growing quickly, but in the overall scheme of things, relatively much smaller than those primary markets that we talk about and show here in the dark blues, the yellow being copper and zinc and lead. So it impacts across the whole spectrum. So if we break that down in terms of what is that, how does that sort of, which are the buckets that we sort of look at within the energy transition. So we've broken them down into 4 sort of core areas. So there's energy generation, there's transmission and distribution, there's storage, and there's the energy transition related infrastructure. So we've listed out the commodities there that in each of those buckets. So you can see in generation, there's a range of different elements that are impacted in terms of energy transition and the generation via solar, wind, and even the nuclear industry is still growing pretty substantially. Some big numbers of new reactors being built and committed to. So in transmission and distribution, clearly copper is a major winner, and that was reflected on that sort of first slide we've seen, but also aluminium and copper, both in cable, predominantly in cables and wiring. So it's really those cable networks where most of the consumption is occurring in those key metals. On the storage side, much more diverse, and I think this is the piece that gets all the attention, is really around batteries, electric vehicles, mass storage, and even hydrogen. The hydrogen piece has got a lot of traction in recent times. So there's a whole range of metals which are sort of fit into that category. Really, we'll just call it the battery complex, if you like, or the energy storage complex. These tend to be smaller, relatively smaller markets, but a much broader range of commodities impacted. And then the infrastructure, it's your conventional steel, obviously all these wind turbines and structures, all the infrastructure around solar, etc., need lots and lots of steel. They need lots of steel not only in above ground, but they need a lot of steel in the underground. So think about all the foundations that those things are set on. If you take them out into the sea, then clearly you've got to 4 times galvanise them when they're sitting in seawater to protect them. Any cables that run from offshore to onshore, you've got to have sheathing on those. Those sheathings are predominantly lead sheathings. So there's lots and lots of sort of, I guess, incremental demand. There's lots of incremental demand on metals that you would not naturally assume are part of this whole energy transition complex. So we, again, so they're the key buckets in terms of the transition. We break them down into 2 key categories in the way that we think about investing into this space. So firstly is what we call the major metals. So these are the very large, deep liquid markets, those big blocks that we've seen on that first slide. And as I said, this is definitively a mega trend where we have a forcing function. That forcing function where the Paris Climate Accord targets and the buy-in from governments is a large incremental demand layer sitting over and above normal cyclicity around global economic growth that impacts the major metals markets. I think one of the key things that we see is that in these major metals markets, there's a lot of constraints around supply, and when there's a forcing function that comes pretty rapidly, like we've seen with the energy transition, demand in no way can catch up. Supply can in no way catch up with demand that quickly. And I'll just give you a number. So the average time to bring on a new copper mine from discovery to production these days is 14 years. So the elasticity in terms of supply is long. And I think Tony Belperio, I see, is here in the audience today. And I think, Tony, you'll remember when we built Prominent Hill back in the day. I think it was a world record in terms of discovery to production then, and that was about 7 years. So it's sort of doubled. The time frames have doubled, probably, in around 15-year periods. So, and there's lots of things that are impacting upon that. So the minor metals markets are the ones that are getting, I guess, a lot of attention, and a lot of attention in the junior space, a lot of attention in the overall thematic of the energy transition, because often they're tied to batteries and battery technologies, but also demands around security of supply, defence, etc. These are very small markets. They have high demand growth, so they're growing very quickly. But, just a word of caution, we have a saying, it's a long-term saying in the business: don't make your primary product what is somebody else's byproduct, because it's very easy for byproduct to be brought on relatively quickly, and that criticality of your mineral or metal that you're producing quickly gets squeezed. And we've seen that with cobalt just very recently. And, one example of that, and it sort of flows through to the critical minerals list, and we just have to be a little cautious around the terminology critical minerals, because you have to ask yourself, critical to who? And often these are very, very small volumes which are critical for certain applications within defence or some other specialist market, which is quite critical to a government who is scrambling in terms of security of supply, but that void can be filled very quickly. And one very good example, and I'm not going to name the names, but there was one particular commodity where the Defence Department was short in the US. It was on the critical minerals list. A major company got a grant from the US Department of Defence to put in a circuit to capture that particular metal. With that one investment of circa $400 million from the US Department of Defence, that mineral disappeared off the critical minerals list. So that's, just things to be cautious and aware of when we talk about critical minerals. So, as I said, they're often captured as byproducts. So those things can quickly ebb and flow in terms of their supply-demand fundamentals. And high prices, as we've seen with Tesla and cobalt, drive substitution or reduction in volumes. So all things to take into consideration when you're investing in the space. And as I mentioned, geopolitics, is playing a big role in this at the moment, because security of supply is clearly a key driver. So that's all on the demand side. So it looks pretty good. In terms of the supply side, this is really what's exacerbating, I think, the fundamentals in the favour of the mining or the producers today and the would-be producers to come. So, we had a 6-year, on the left-hand side, it's capital investment. So this has taken the broader market. So just capital investment cycle versus sort of a basket of base metals commodities and the price, the overall price. So we intuitively sort of know that the prices have risen pretty significantly, and we're all pretty happy with the prices that we've got today, although at times you wouldn't know that. But you see that 6-year period leading up to sort of 2016, prices were up, there was, quite a lot of investment flowed in. Then when prices came off, the capital investment dried up. So, companies are returning any excess growth capital back to shareholders demanding dividends, which is rightly so. But this is a long-term capital-intensive business where your assets are depreciating every day. So you need to continue to reinvest into those assets for long-term sustainability. And in an age where people can't think past 5 minutes, that's a pretty hard thing to convince people that it's a good idea. So capital's come right off and prices have picked up, but the amount of capital actually going in an overall sense continues to come down. And, we're seeing that price elasticity, particularly in some of the smaller markets with high compound growth like lithium, that elasticity where CapEx is a long, long way behind demand, the price elasticity is extreme. So, that needs to pick up substantially. It is picking up, it has picked up, but nowhere near the degree that it probably needs to get anywhere near meeting the demands that are required or the materials that are required to meet those sustainable development goals or even the stated policy goals. And I think government's sort of only just starting to realise that now. So on the right-hand side, it just goes to individual commodities. This just shows in 10 years' time, there's the increases in materials, and I touched on copper and zinc earlier on. So, with 40% increase required, copper over 30% increase required, etc. So, these are already large markets. It's very difficult to bring on new supply quickly. And even the smaller markets, the smaller, relatively new markets like lithium, cobalt, and graphite, there's fundamentally limitations on how quickly that material can be brought on. So all of that means, we should be in for a sustained period of above average pricing for most commodities. So look, I think many people will have already seen this. So the mad scramble, the anxiety, I would call it, in governments globally. So with, what I would call de-globalization, there's this very, very rapid realisation that China particularly, we've always known this as producers into the industry, that in most commodities, China was pretty short of raw materials of their own, but they have taken the lion's share of the processing capacity across most metals. So you can see there, in terms of percentages on the processing side, China just dominates on the process, refining and processing of most minerals. And their share of battery production even, I guess, more alarming for those who are concerned about security of supply. So the anxiety around critical minerals, government scrambling, is really, a lot of it is related to this security of supply issue. The penny dropped, and all of a sudden, I guess there's a realisation that there's an over-dependency upon a single jurisdiction, and governments globally are looking to shore up, I guess, their own security of supply. And I think the supply challenges around COVID, that COVID period sort of exacerbated that, and we've come out of that, and all of a sudden, there's this sort of, I guess, mad scramble, I would call it, and I'll touch on. And you see it every day, every second day or every day, there's an announcement from a government about some incentive to bring on, some form of raw material supply. So we sort of capture that here in this slide. So this is really, just again on the impediments to supply growth. So the emissions reduction targets were put in place, but the regulatory overlay to enable new mining projects to come on just hasn't followed quickly. And I don't think, I don't see any indications that it's going to catch up. In fact, if anything, it's actually getting more difficult to permit because predominantly, there's a very strong ESG overlay, and that sort of regulatory environment is harder and takes a lot longer. I've already touched on the mining company's allocation of capital, so the growth capex really hasn't happened. A lot of the surplus cash has gone back to shareholders. And a lot of the companies, because those government policies have been put in place in the first box, the companies are actually scrambling themselves out of necessity to get their own emissions reduction programs in place. So it's taking that capital away from bringing on new supply for the energy transition because they're actually got to get their emissions reductions programs in place faster than they otherwise probably would have thought they had to do. So, and then in terms of the investor capital allocations, again, one of the things that we see, we have people sort of sit and sort of see EMR Capital as a capital provider, but we also ourselves have to attract capital from other sources. And, we also have, a lot of sort of, within our operations, debt providers. So, there's a terminology, I don't know if everybody's heard it, but it's put into a bucket called extractive industries now. And so your banks, your traditional banks, moving away from extractive industries, lending to extractive industries. A whole range of capital providers into our business moving away from mining because it's an extractive industry. So there's a sort of a shortage of capital. There's always someone who'll step into that breach. And in a couple of slides, I'll just go through who are those that are stepping into the breach. So, and there's also this sort of, how am I going to play the energy transition? So the providers of capital, how will they play it? They'll say, well, why would I go into the upstream side? It's high risk, it's high capital versus I can play a, technology or manufacturing piece of the puzzle. So, these are all impediments to new capital coming in. So look, I've just honed in here on the battery supply chain, and I've broken it down, and I won't go into the individual pieces of this, but you can see there's a whole range of segments and there's a whole range of players, and they are essentially ranging from the mining through the processing and refining, and then the cells, the battery packs, and so and then the end users, the full value chain. We're seeing a lot of activity down the midstream, predominantly the sort of downstream piece. There's a lot of the activity you're seeing in the battery mineral space is in that sort of last three boxes. But one of the trends that's it's becoming clear is that we're seeing, because of this constraints on supply, the demand pools, the actual battery manufacturers and the end users in terms of vehicles, etc., are very worried about supply. So they're moving up into the processing, refining, and into the mining piece. So in my career, I've never seen those guys actually come up and invest into the mining piece themselves. So they are moving up, and I'll give you a couple of examples. And then we're also seeing the mining companies realising that, hey, you know what? There's a value chain here which is 100%. I'm a miner and I'm getting 6% of this value chain or 8% of this value chain, and actually coming down and partnering with those end users or midstream users to come into the processing and refining space. And we're seeing that in WA. We've seen a lot of the guys, well, the small number who started out in lithium as miners, actually now a lot of them getting involved in that sort of processing and refining side. So they're coming down, and the guys at the right-hand side are coming up. So look, again, just on that same sort of thematic, the Asian battery manufacturers, and this is all to do with emissions reduction and barriers in terms of emissions reduction. So the battery manufacturers are actually increasing their capacity in Europe. They're increasing their capacity in the US, so predominantly the Asian battery manufacturers, whether they be Korean, Chinese, or other. And then, as I said, we're seeing some direct investments coming into the mining space. So LG, Keynote, Impediments, these are a couple of examples. There's many more than this. General Motors in Queensland Pacific Nickel. And then, to me, this was a really big surprise where we've seen Stellantis actually invest in a copper mine development in Argentina. So, I never thought I'd see the day when a car manufacturer would be investing into a mine development in Argentina. But that's actually what's happened, and there's more and more of those things sort of coming onto the radar screen. So look, so as I talked about the government policies and, there's incentives. So look, there's a whole range of things, and I'm not going to go through these individually because I'm running short of time here, but there's lots and lots of, investments from governments, there's grants. But look, these things are slow. They can take, 18 months to 2 years to actually win one of these grants. It's not like they're being handed out tomorrow and the capital can be deployed quickly. Talking to those guys at Sierra and Talon and various other places, these have been 2-3 years in the pipeline to get these deals actually done. But there is a lot of money coming from governments and a lot of incentive money to bring on these raw material supply. So what I call the capital pools is really expanding, and I think I've given you a bit of a flavour of that as we've gone through today. And we've just sort of, plotted a bunch of boxes here. And there's some empty boxes because there's new players coming into this space every day looking to get exposure to this mega trend that we talked about. I mean, as I said, it's here to stay, it's unstoppable, and it's very, very large, and capital flows are coming into the space, and everybody wants to get a piece of the action. So I think, as participants in the industry, we just need to keep that in mind front and centre. The diversity of capital pools has changed a lot. The traditional capital providers are still there, but they've got a lot of competition from new players. So look, just quickly, Australia is in a great position to capitalise on this. We have, a pool of fantastic entrepreneurs in this country who I differentiate as the entrepreneurs in Australia, in a general sense, want to build mines. And I always point out that in Australia, geology, say in the gold sector, compared to Canada is probably pretty similar and pretty much the same size. In Australia, how many undeveloped million-ounce gold deposits are there? Not many. How many are there in Canada? Hundreds, because in Australia, people actually set out with a purpose to build a mine and create real value. So our entrepreneurs are really mining entrepreneurs. They're not stock market players. So, we've obviously got a combination of the two, but in a general sense, we've got great entrepreneurs who've built great businesses, and, you can see them. And because of that, we're actually the leader in the lithium hard rock space. Like, we're the leader in the lithium production already because of that entrepreneurialism we have here. So it's sort of the onus is really on us to capitalise on that. And, it's a brand new... We've heard all the complaints about iron ore and downstream, adding value, etc. This is a brand new industry. We've got a huge opportunity, and there's been some vocal proponents of that. But across the whole scheme of things, Australia is extremely well placed. So we need to take advantage of that. So look, just, so thinking about all of that, pulling it together. So above average trend growth for energy, anything tied to the energy transition in terms of metals. The impediments for new supply actually look like they're getting more difficult rather than less difficult. Supply anxiety due to security of supply issues is making, capital available from a whole range of different sources. As I said, new pools of capital, large pools of new capital coming in, and Australia's sort of a leader in that and will benefit. So So look, had EMR sort of pulling, the way that we've sort of done a lot of work around this, and I've touched on a few of the themes today. I mean, we'll continue to focus on the primary commodities in the energy transition, the big, deep liquid markets with low substitution risk. It's going to be a very, very volatile space because of those supply-demand dynamics that I've talked about today. There is a lot of push and pull in many different areas. It's very complex. So, put your hard hat on and brace for volatility because it'll come. So the best way that we always see to protect yourself from that is just to be at the right end of the cost curve. I mean, it's a pretty basic fundamental, but sometimes when there's a lot of excitement, we tend to forget about fundamentals and get carried away with things. But protect yourself from volatility. We want to protect ourselves from volatility by just being in the right end of the cost curve, whichever mineral we're in. We do want to take advantage of the need for the critical minerals, but we do it a different way. We do it really think about it as a byproduct and as an add-on to our primary business. So, even when we're diligencing new assets these days, or within our own operating businesses, how can we capture value from the critical minerals byproduct streams? Because there's capital available from governments and various other players to help you do that, which was never there before. So the incentive is there, the capital availability incentive is there to actually capture those byproduct credits. So as I said earlier on, don't make those your primary product because you'll be sure that I'm not the only one thinking about this. It's already happening. It's already happening in spades. Look, bit of a motherhood, but, just again, quality assets and, you got to think about the audience with all of these players coming into the space. They have different reasons for wanting to participate in the energy transition. Sovereign wealth funds, for example, they're looking to take advantage. They're looking to set up completely new businesses within their own countries to create employment. An OEM's looking to secure his supply. There's a whole range of different reasons that people in space. So when I guess when you're going out to those audiences, the good thing is there's a much larger pool, but when you're going out to them, think about what is it that they actually are looking for in terms of your pitch to them, and why you represent a good investment proposition for them as part of their own business. And I think, for us, we are a mining PE fund. We've invested heavily in our team, and our team are operators, and we've got to work to our primary skill set. We don't have a bunch of processing engineers who can go and do lithium brines in Argentina or chemical engineers. Our expertise is in mining, so something like hard rock lithium fits well with us. It's conventional mining, it's conventional processing, produces a concentrate. But it is an industrial mineral, and what people often forget is industrial minerals have very tight specifications in terms of product. But that's something that we ourselves have had a lot of exposure to over a long period of time. So play to your strengths. So I think that probably brings me to time. So thanks, everyone.